Investment markets have been pulled in many directions this year, with the changing fortunes of commodities, currencies, and market corrections. Further change is perhaps in the wings, with expectations rising that the Fed is preparing to lift interest rates in the US this December. While volatility has generally risen, there have been some bright spots. Both the Japanese and European equity markets have performed well and offer potential upside. While the US has been relatively flat, it has recovered sufficiently to be trading near its all-time highs. China's equity market has been an absolute rollercoaster, while Australia has struggled, primarily because of weak commodity and energy prices and the underperformance of the dominant financial sector. Looking at Europe, we saw the European Central Bank implement a significant quantitative easing program at the start of 2015. While the early going was good, Greece again played a destabilising role for financial markets before succumbing to reform demands for bailout funding. Then, just when things were looking to settle down, the Volkswagen emissions scandal struck, denting investor and economic sentiment in a time of market volatility. The ECB is again preparing the ground for more monetary stimulus. While wider Eurozone sentiment is positive, longer-term inflation expectations have deteriorated, giving the ECB enough reason to increase its monetary stimulus. An interesting backdrop against the prospects of a hiking Fed. In the US, it remains as much a case of will they or won't they. Based on expectations of a low trajectory path, markets need not fear a rate rise. If there is any overreaction to a policy move, it could actually provide a short-term buying opportunity. While US equity market returns have been flat, there has been strong divergence across sectors. Energy has been in the doldrums, tech has gone from strength to strength, while healthcare has been mixed. If the best way to cure a low oil price is with a low oil price, then prices should gradually recover over the medium term. We are already seeing dramatic cuts in capex. Combine that with ongoing world depletion, and the supply-demand imbalance should move closer to equilibrium. With geopolitical tensions flaring again, select energy companies can provide some diversification benefits to a portfolio. In general, the tech sector has continued to stride forward. After a poor 2014, Amazon has put in a strong year, helped by disclosing the growth of Amazon Web Services. Facebook has also surged past $100 as it continues to lift user engagement and drive mobile revenues. Healthcare has been mixed off the back of a Hillary Clinton tweet on price gouging. We've also seen the dramatic plunge in the share price of hedge fund favourite Valiant Pharmaceuticals. While the sector has been mixed, it shouldn't discount the ongoing R&D breakthroughs in areas such as immuno-oncology, with companies Bristol Myers Squibb and Roche amongst those leading the way. Over now to China, where its economy continues to undergo an economic transition. There were fears ignited due to a sharper than expected slowdown in growth, resulting in the stock market correction in August and September, and with the negative sentiment reinforced by the surprising devaluation of the yuan in August. Nevertheless, increasing wealth, rising wages, and a growing middle class provide significant economic potential not only to China, but to the world as a whole. The country has the means to manage the current slowdown, and growth now appears to be stabilising. Back home, consensus earnings forecasts for the next year have continued to trend lower, and while we expect that the majority of the negative revisions have now been factored in, we would not expect a sustained rally in local equities until we get more clarity on the future capital requirements for the banks and global commodity demand. Regarding resources stocks, any turnaround in current earnings expectations will need to be driven by higher commodity prices, which does seem a little unlikely. Despite the less than inspiring earnings expectations, the Australian equity market's relative yield advantage should continue to be a recipient of investor support. Both debt and equity markets do have reasonable outlooks. Valuations appear attractive for credit markets over the coming months, and technical conditions should improve further. And while Treasury yields should continue to price in higher rates, moderate growth in the US and globally are likely to limit any yield increases. Eurozone equities should further benefit from an improving economic outlook, and expectations for further monetary stimulus will support equity markets. The same is true for Japanese equities. Profit margins and stock market valuations in both regions are well below levels in the US, providing more potential for the upside. In Australia, a slowing housing market gives the RBA some scope to ease further if the green shoots of recovery do not play out as envisioned, with growth in the local economy proving as challenging as our local market, which remains at the whim of the resources sector and the fortunes of the large banking stocks. With global shares having a more favourable earnings outlook, we maintain our preference for global over local shares for the time being. We invite you to follow the Zurich Investment's Pioneering Insights blog to keep you up to date on Zurich's views on local and global markets and the opportunities they bring for investors. Visit pioneeringinsights.com.au.